Well, if you're like most people, you probably are on autopilot when it comes to saving for retirement. Likely on every paycheck, money is automatically drawn into your retirement plan. You may also have a company profit sharing plan or a pension. Then there could be money saved from your previous employer's plans. The end result is a do-it-yourself approach to retirement. With us this morning, we have financial advisor Jonathan McCoy in studio to explain why the team approach to retirement could benefit you and your investments. So Jonathan, when it comes to these do-it-yourself investors, they meet with you for the first time, and for some of them, is the tax part of the team often finding that there were tax shelters or consequences that may have been overlooked?
Well, yes, and a lot of times this is what I reiterate, especially to what we consider the do-it-yourselfers, the folks who've managed their own investments, done their own taxes, kind of managed their own household budget and expenses and all those things. It's great because that educates you really well on how the financial world works, but the tax piece of it when switching from your accumulation years to your retirement years can be pretty tricky. And working with a team of CPAs through Market Advisory Group with Market Tax Services, we're bringing our CPAs into the conference room, reviewing the portfolio with them, and oftentimes we're saying things that could have been adjusted over a period of 5 to 10 years, even prior to retirement, that maybe were some things that were missed. So especially for the do-it-yourselfers, I'm often reiterating that it's important to have a tax team at your disposal because we can't all know it all, and Google's not going to tell us everything.
Right, and hindsight's 2020.
Right.
So for many who didn't reallocate funds and rode this wild market, they're starting to see somewhat of a slow comeback, and some of those people have been reluctant to keep investing. Could people be missing out on possible financial gains?
Yeah, ultimately, yes. I mean, there were some people that we've talked to that panicked and pulled out earlier this year, and some of them pulled out right at the bottom, right at the worst case scenario when the market started to bounce back. And we'll see if the bounce back is sustained. Of course, we've got election cycle coming up that could be always a little tenuous with the markets. But really what we continue to try to teach people is you've got to have a plan in place ahead of time that has already previously accounted for these market downturns. Instead of having to emotionally react to what's happening during the downturn, you should have a plan in place to supply and provide the income that you need to live the lifestyle that you want, even if the market goes through a downturn. And we're finding that the people that are reacting emotionally have not had that plan in place.
And that's where the do-it-yourself approach can be a little risky, I'm sure.
Can be somewhat dangerous, yeah.
And we always hear in life, the greater the risk, the greater the reward. Are there forms of investing that can help you with, being well allocated while still managing the risk?
Yes, ultimately, and you talk about diversification. A lot of people think of that, how much are you having in stocks and bonds and all these different asset classes, but looking outside of the variable market where we're looking at stocks, bonds, and things outside of those types of investments, people are missing a lot of the picture to help determine, between pensions, Social Security, and other guaranteed forms of income streams, what might be those appropriate tools to, once again, help you survive these market downturns, but also provide growth. Helping offset the impacts of inflation right now over the long run is an important factor as well.
And we do have just enough time for a viewer question. This one is from Jan. Jan asks, my neighbor's husband recently passed away. They had been married 43 years, didn't have children. She said when she tried to access the money in his IRA to help with funeral costs, she couldn't because there wasn't a will or power of attorney. Do things like this really happen?
Unfortunately, yes. We see it most often, especially if you have an incapacitated spouse and don't have things like these power of attorney documents in place. So once again, talking about the team approach, we have our estate planning attorneys, we've got our CPAs, we have our Medicare advisors to help with that transition from work-related health insurance to Medicare once you turn 65 or once you retire. And then we have the financial advisory team that works with all of those professionals in-house. So the estate planning side of it is really what Jan is talking about here. And a lot of those pieces that people often miss because you have not had a professional tell you, here's really some things that we need to get in place for you.
Always good to seek a little extra help.
That's right. And we need it too, as financial advisors even. So,
Jonathan, thanks so much for taking the time today.
Thank you.
And to schedule a complimentary consultation and submit your questions, visit AskOurAdvisor.com or call 816-548-2000. They'll take your questions and even meet with you one-on-one free of charge. And if you include your address, Market Advisory Group will send you a free gift.